everybody. Luke Gromen, founder and president Forest for the Trees, FFTT. Hope everybody had a great weekend here for another two things that caught my attention recently on a Sunday night. I'm going to jump right in. First off, we recorded a MacroVoices interview that was released on Thursday evening. If you haven't had a chance to listen to it yet, I would encourage you to do so. I think it covers an important topic, and to me, the bottom line key takeaway is that true interest expense, which is we define as gross interest expense plus entitlement pay-go expense annually for the U.S. government. Those two line items are really the true interest expense of the U.S. government. And as we've modeled it, assuming there are no slowdowns anywhere in the world, we are under 24 months from those two going over going over 100% of tax receipts a few months ago. If there's a slowdown anywhere, that date gets pulled forward. The point is that all of a sudden you're seeing in the media all over the place deficits don't matter, and ironically, for the first time in 50 to 70 years, they do matter, and they're going to matter a lot sooner than most people think. So take a listen to that. I think you'll enjoy it. The second thing I would highlight is, of course, the Berkshire Hathaway letter came out this weekend, and it was fascinating to me, among other things, to watch Warren Buffett bash gold again, which is a favorite pastime of his. But a few sentences later, after he bashed gold again, he makes an incredibly strong, paradoxical bull case for gold when he lamented how difficult it was for Warren Buffett and Berkshire Hathaway to put cash or put money to work as fast as it's coming in. And what he is saying by saying that was summarized brilliantly, I thought, by Tom Brammar on Twitter, which is that the world is awash with credit, or dollars, backed by ever-diminishing collateral. And of course, gold is collateral par excellence. And so when Buffett says, you know, gold is bad, and then turns around and says, I've got so much cash coming in, I can't find any good deals to buy it, I can't find acceptable returns on capital to buy, to put that cash to work, you're saying there's a collateral shortage. And so that would all else equal be good for dollars, of course, be good for treasury bonds, be good for gold. So I thought that was an interesting comment that he made, where I'm not sure he realized what he was saying, but he did. So I'm going to jump in. Before we jump into questions from tonight, I got a couple of questions from last week's Periscope. So the first question is, I was wondering if you could address or recommend where I could find some information about recent changes regarding the Basel III banking regulations, about how capital requirement is calculated regarding gold. I would encourage you to go to Slavomir, I would encourage you to go to the BIS's website. There were reforms done or approved in December of 2017 to the Basel III banking regulations, and in those regulations there is a change in the treatment for gold under certain circumstances, so that it is rated, risk-weighted on par with sovereign debt, which I thought was a potentially very important dynamic. I don't think it's necessarily the only reason why central banks bought more gold in 2018, or a record amount, but I do think it is the BIS effectively blessing gold as a reserve asset, or moving gold back into the system, as it appears central banks are doing. Second question from last week was Junjur saying, can you discuss a little bit about emerging market currencies? Which EM currencies are better positioned? To me, the world is moving back to a more multilateral system for commodities in particular. If that happens, you're going to get into a more balance of payments system. And so if the world's moving back towards a balance of payments centric system, then the best currencies are going to have the highest balance of payments, highest current account surpluses, and the highest FX reserves as a percent of GDP. And if you rank them in those orders, that's how I would run my screens on that, as this system continues to move from dollar-centric to multilateral and therefore balance of payments centric. Last question was, can anyone explain the mechanism where the yuan depreciates and gold flows from London to China? From Freddie Mercury, which is back from the grave, to ask this question. Why does it happen? And I don't know. It happens. It clearly happens. And I've kind of floated a couple trial balloons out there on Twitter and discussions, and so far people, I think, are noticing but not really asking enough questions about it, which is to say, every time the yuan-dollar ratio nears 7, London begins to absolutely hemorrhage physical gold. And they hemorrhage it for a month or two, and then the hemorrhaging stops once the yuan-dollar begins to strengthen. So I don't know why it's happening. It's been happening for 2.5 years plus, but it's, I think, a potential important point. So I'm going to jump up here to some of the questions here, and let's see. All right. Is the recent palladium spike foretelling of something for gold? Hi, Mike. Palladium is, of course, an industrial metal, and so it's a little different right now, or it's a little different on that front. But I do think ultimately it is foretelling a little bit from the standpoint of you've got a shortage or a collateral problem in palladium. When it's a productive or used in industry, it's harder to paper over, right? You can't staple some COMEX contracts to the bottom of your car as a catalytic converter. You got to have the palladium. So I think directionally it's a decent way to think about that. So let me see here. There we go. Trying to get it to toggle up, and sometimes I can get it. There we go. Okay, here we go. Deep throat pump and dump thoughts from a deep throat IPO who's a blogger, has a very good following on online. Wrote a blog post that was lengthy, that was effectively detailing the China, what he calls a China pump and dump, which I think is we didn't use the phrase pump and dump, but in an interview about a year ago with Grant Williams, we said what we thought China was doing was an epic arbitrage, where they were seeing that the supply of dollars has to basically hyperinflate in the next 10 to 20 years due to entitlement obligations, whereas the physical supplies of basically everything else isn't going to hyperinflate, and so they were basically borrowing everything they could, shorting dollars, and locking up supplies of more finite assets. And Deep Throat's blog post certainly details this. What I thought was really notable is Deep Throat's been a staunch yuan and China bear, and he reversed himself in this, where he said, look, I don't think the yuan is going to fall against Western currencies. I think Western currencies are going to fall to catch down to the yuan. And so my line of thinking dovetails with that, so I thought it was a really interesting blog post. Let's see. Hi, Max. Who's buying the equity market while fundamentals are obviously rolling over? I think I agree. You could be seeing buying an expectation of a trade deal, which, last week we got pretty explicit indications that the yuan-dollar cross rate is on the table and is being discussed. If we, we want a stable yuan, I would read that as we want a weaker dollar against the yuan. The markets would likely rise on any type of weakening of the dollar related to that. So maybe there's some speculation or informed speculation regarding that. And I think too, just the importance of CTAs and algos, trend following. You've had a sharp bounce, and they're following the trend, and so I would suspect that some of that has something to do with all of that. All right, let's see here. Okay, going to try to toggle down now. There we go. Okay. He bashes gold because he knows what his endorsement would entail, a run on the bank. He was buying silver in 1997. He talked about that. Warren Buffett is I think people underestimate how politically tied in he is. I mean, let's think about this. Who was brought in to save Salomon Brothers in the early 90s? Warren Buffett. Who was brought in to save Goldman Sachs in 08, 09? Warren Buffett. Who was brought in to make a big investment in Bank of America? Warren Buffett. And so there is an element of he is very well tied in. And so I would not expect him. I would not expect him to ever vouch for gold or say he likes gold, despite the fact that his father very much did like gold. Wrote a lengthy paper about the virtues of gold and the gold standard back in '48 or '49. But to me, the biggest thing with Warren Buffett and gold is just that he was 2.5 years old the last time you needed to own gold. And so he's right. For 77 years, it's been irrelevant, or 87 years, whatever he said. 77 years, I haven't needed gold. He's right. And you know what? About every 80 to 100 years, you don't need gold. And then in a brief period of time, you need gold, and then you sort of don't need it again for another 80, 100 years. And we're there, or we're awfully close to there. So I think he is doing a disservice to some investors by ignoring what happens in when global sovereign debt bubbles burst. But again, what's he going to do? Tell people there's a global sovereign debt bubble? And you can see he all but told them that 7 years ago in 2012 with comments he made about the Treasury market back then, which he thought they should come with a warning label. So that to me is pretty interesting. Let me see. I'm going to try to. Oh, there we go. New comments. Okay, here we go. Let me see. Say within 24 months from last September, unless a slowdown any in the world, we're slowing. Yeah, that's exactly right, Doug. When we first did some of that math that we laid out on the MacroVoices podcast, that we had 24 months. We did that math in early September. Ray Dalio talked about that math right around that same time, about 24 months away. And that was assuming you weren't going to get a slowdown anywhere. And of course, the world is slowing precipitously. And so to me, I would take the under on 24 months from last September. I would have anyway. I definitely would now. So, now you talk about something that most people think is 5 to 10 years away, and it might be 18 months. It might be 14 months, and the markets will start discounting it within 6. So it's important to watch. So and critically, there are a number of different things we can do to change that, right? It's not just about is the economy slowing or is it not slowing. It's what do we do with entitlements. It's what's death rates do in the U.S. It's what does the dollar do. It's what do rates do. There's a lot of different inputs to it, and you can make adjustments for it. But ultimately, it's important to pay attention to. Let's see. Any significance to Kim meeting time to Xi Trump pending agreement? Good question, Tom. I hadn't really thought of that, and I'll keep an eye on it. Let's see. Don't build my argument on gold. It's archaic. We have a digital solution that's equivalent. Yes, ultimately, as long as you don't have quantum computing or something like that that can break the digital equivalent or counterfeit the digital equivalent, and that exhausts my knowledge of that. So I don't know anything more on that, but. At any rate, let's see. What is my worst case scenario in terms of percentage decrease for U.S. tax receipts 24 months from now? I think in the worst case scenario, I'd have to go look at the scenario I ran, but that worst case scenario where I had it had it by mid 20 or late 2020, where tax receipts, where interest expense, true interest expense is exceeding tax receipts. I think I had tax receipts up. Slightly, like 0.5%, which right now they're running down. Let me see. Hi, Michael. Tax refunds falling significantly year over year. Is that significant? I think it might be, but I would want to see more data. What I do think is significant as it relates to receipts is in 2018 receipts were down after the tax increases, and despite 2 straight quarters of 4% plus real GDP, you still finish with tax receipts down for the year. That is not how it was supposed to happen. It is not how it worked with the Reagan tax cuts. It is not how it worked with the second of 2 Bush tax cuts. there's supposed to be leverage in the economy when your GDP grows 4 to 5% on a real basis, and there wasn't. And that is an important piece of data that has generally been sort of glossed over after the tax receipt data came out. But I think, it ties into this freight train is coming a lot sooner than most people think. Let me see. Hi Jeff. You're overweight dollar, treasuries, gold. What signal to sell dollar and treasuries? I really thought we would need a much bigger crisis to see the Fed blink, and I'm a little surprised that they blinked. I am and I'm not, but I ultimately think you're going to need the Fed to get more explicit to sell the dollar. And where do you go? To me, when they blink, when they get much more explicit about blinking, I think gold wins. I think gold wins whether things are orderly or chaotic from this point. I think you would go to equities. I think you'd go to emerging market equities, in particular commodities, etc. Let me see. Take on gold stocks or GLD. If I want to own gold, I would rather own physical, held out of the banking system. So there's private vaults around the country in various metropolitan areas. I would want to own gold bullion coins in one of those vaults. Is how I would want to do it. There's cash settlement language that's sort of boilerplate stuff, I'm told, in GLD's prospectus, but it's there, which is you would just hate to be wrong for the right reasons on a GLD. Hi Tom, any thoughts on major gold miner consolidations? Yeah, I think they're really interesting. Historically, you see these types of consolidations in industry, nearer to bottoms and nearer to tops. And so, given where we are in the gold market, to me, my guess is it's probably nearer the bottom than the top. And so I think it's an interesting timing, particularly when they came so quickly on the heels of Sam Zell saying he's buying gold for the first time in his career because of a supply-demand mismatch, which Zell has been very, very good on the big things for very, very long. Let me see. Are buybacks over for this cycle? I'd be surprised. No, I don't think so. Hi, Jeff. PHYS. I like, if I had to own an ETF, I would probably favor PHYS. I particularly like that within their prospectus, if you own the equivalent of a London gold bar, they will allow you to physically convert that. That is attractive to me. Alrighty, that is. I think that's about it for tonight. We're finishing up here on coming up here on 7:20. So listen, I appreciate everybody jumping on as always, and I look forward to catching up with you guys all on next Sunday night. Have a great night. Good luck this week, and we'll talk with you all soon. Take care, everybody.